thank you so much for making it out on a sunny, rare sunny Oxford afternoon. Hi. So welcome. My name is Alex Money. I'm a Senior Associate in the Oxford Sustainable Finance Group at the Smith School. And on behalf of the Oxford SFG and the team, it's my pleasure, of course, to welcome you to this lecture, the Green Financing Prize lecture that is sponsored by Insight Investments. And of course to be introducing the prize-winning lecturer in a second. So I was lucky enough to be at the event, at the summit actually last year, when the prize winners were announced. And so I'm especially delighted, of course, to be able to be introducing the prize winner to give that lecture. Hey, come on in, find a seat. But before I introduce a couple of things, there are loos just outside on the left in this very fancy building. Perhaps more interestingly and importantly, there is a drinks reception after this event, which will be again left up the stairs in the Abbott's kitchen. And so Caroline will, I hope, be joining us for that afterwards. You'll have a chance to speak to her a little bit more, and that'll run till about 6:45. If you have the urge to run out of the building screaming, you'll be pleased to know all the locks have been disabled on the doors. So I'm told by the porter just to push them hard and you can carry on your run. Okay, so to the lecture. So the topic today is ESG versus system level investing. And the speaker is, of course, Professor Caroline Flammer, who is the winner of the Outstanding Research category of the prize last year. Caroline is the Barton Hepton Professor of Economics at Columbia University in New York, along with quite a long list of other appointments, having reviewed her CV. She's internationally, hey, how are you doing? Find a seat. She's internationally recognized as an expert in sustainable investment. I'll leave her to talk more about her actual work in the lecture, but I can assure you that you're in good hands. Caroline is amongst the top 100 most highly cited researchers in business and economics in the last 10 years, which is a pretty competitive field, as you might imagine. Anyway, she'll give a lecture for about 45 minutes, something like that, and then there'll be an opportunity for questions, which she will be happy to take from you thereafter. And so I really encourage you to kind of engage with the lecture and ask things that are on your minds. I recognize lots of faces here of people who are doing some really interesting work in sustainable finance. So hopefully there'll be a really good opportunity to talk about that. And then we'll go up for the reception. So that's really all I had to say, apart from just to let you know, so Caroline is obviously the winner from the prize of 2023, and nominations for those prizes are still open for 2024, and they stay open for another 9 days, I think, till the 24th of May. So you're warmly encouraged to make a submission for that award in the next week or so. Okay, very good. I think that's enough from me, and let's move on to the main act. And please may I welcome Professor Caroline Flammer. Thank you very much.
So thanks so much. Thanks so much for the warm welcome. Thanks so much for inviting me, and my deepest gratitude for the prize. It's my deepest honors to be the inaugural winner of this prize. So my keynote is going to focus on ESG versus system level investing. Let me get started with the real economist perspective. Okay. So from a real economist perspective, the big picture question is: do companies' social and environmental responsible practices help improve their competitiveness? And the short answer to this question seems to be yes, they can. And specifically, you can see this along several dimensions. For example, companies' social and environmental responsible practices can improve their competitiveness by fostering innovation and prevent knowledge leakage, by enhancing employee governance. It allows companies to attract, motivate, and retain talented employees. CSR can also help companies to improve their competitiveness on the product market and on the market for government procurement contracts. And it can help sustain their competitiveness during times of economic crisis. And so perhaps as a result of these different aspects, it's not surprising that companies' sustainable business practices can positively affect shareholders' perceptions and shareholders' returns. So the bottom line is that CSR, or corporate sustainable business practices, can be beneficial to companies on average. As such, you would expect that it should be an integral part of corporate governance and strategy. But you know it as well as I do, this is often not considered to be the case. And this begs the question of why not? Why, if on average companies' sustainable business practices are beneficial to companies, why do we not consider to be core to strategy? Well, one potential reason is a lack of good corporate governance practices, such as a lack of long-term incentives and a lack of private incentives to care about these societal and environmental practices. Okay? And so, for example, in these two studies, we show that well-designed governance structures, such as the linking of executive compensation to long-term financial performance or to social and environmental performance criteria, can not only improve the company's sustainable business practices, but also help increase firm value. So, in other words, the E and S of E, S, and G are not separate, but rather an integral part of G, namely governance. Now, before I go on, let me take a step back and look at the broader context. What's going on in this world? What are managers facing these days? Well, on one hand, they're exposed to increasing risks and costs associated with climate change. For example, an increase in energy demand, damage of coastal property and infrastructure, the decrease in public health, water supply, and agricultural production. Secondly, governments increasingly take actions to curb climate change, and a prime example is the 2015 Paris Agreement, where 195 nations agreed to limit global warming to below 2 degrees Celsius. And in fact, even the threat of strict environmental regulation can send a strong signal to investors of carbon incentive companies, and hence change their behavior. Third, companies also face increasing pressure from social activist groups, pressuring the companies to take actions and improve their social and environmental responsible practices, and this pressure has intensified with the use of social media. And perhaps as a result of this, it's perhaps not surprising that even investors, the very own shareholders of companies, increasingly show interest and concern about the portfolio's companies' environmental and social practices. You can see this along several dimensions. For example, you can see an increasing number of signatories of the UN Principle for Responsible Investment, which is the largest network of responsible investors globally. You can also see this in terms of an increase in the demand of the adoption of a longer time orientation, in improvements in corporate environment and social responsible practices, and investors also increasingly pressure their portfolio companies to disclose their exposure to climate change risks and what they do about managing and mitigating these risks. Let me delve into some of these to just show you these trends over time that investors increasingly are concerned about these broader societal aspects. Okay? The first study I'm going to delve into, not deeply, but I'm going to briefly touch on it, is the company's environment and social responsible practices. So here we are looking at shareholder proposals that are submitted to the annual meeting by the investors, and these topics are on environmental issues, the development of sustainability report, social issues such as the addition of minorities and women to the board, animal rights, health issues. It also includes social issues such as human rights, labor issues, political issues, etc. Now, what I'd like you to take away from is the trend over time. Okay, so this study is a little bit dated. So I looked at the time period of 1997 to 2012, but the trend is what you should take away, and obviously it has likely increased over time. So what you can see, there's an increasing number of shareholder proposals on E and S submitted to the portfolio companies. Also, the approval rate has improved, and the average vote outcome as well. Now, let's face it, the average vote outcome and approval rate is still miserable when it comes to E and S proposals. Okay? But what is quite striking is, again, this increase over time. If you look at what kind of topics, issues investors care most about or are most concerned about, what management is not doing, that's labor issues and environmental issues. Now, if we were to do this study again during this past decade, you would probably see also an uptick in proposals related to the addition of minorities and women to the board, as well as the development of sustainability reports. Okay? Now, who are these investors who care most about and are most active in submitting shareholder proposals? It's the nuns, the religious groups. Okay? But they're also phenomenally unsuccessful in getting approval by the other investors to vote in support of these proposals. Similarly active, but much more successful in getting the approval of the other investors to vote in favor of these proposals are public pension funds and sustainable responsible investing funds. Now, there are different reasons that may explain this pattern. One potential reason is the way these proposals are framed. If you do a textual analysis, the religious group tend to make an ethical case, while public pension funds and SRI funds tend to try to make a business case. Okay? Obviously, if you try to make a business case, you might be more able to get others to vote in favor, regardless of whether they care about the actual issue at hand. But they might care about firm value. Okay? But again, there might be other reasons that may explain these different vote outcomes. All right. So what I found actually in this study is that companies that improved, that adopt these proposals and improve the sustainable business practices, indeed show an improvement in firm value, suggesting that increasing the sustainable business practice is value enhancing. All right. Another way where you can see that investors increasingly care about their portfolio companies' social and environmental practices is in terms of their disclosure of the portfolio company's exposure to climate change risks. Okay? Now, what is important to understand is that in most countries around the world, there's a lack of mandatory disclosure requirements when it comes to non-financial information, which includes the disclosure of exposure to climate change risks. For example, in the US, the SEC merely recommends the companies disclose their exposure to climate change risks, but it does not mandate it, nor does it provide really any guidance in how to do it. Now, there is some update, okay, earlier this year, but that has come to a halt as well. So, de facto, at this very moment, in many countries around the world, including the US, there is a lack of mandatory requirements to disclose the climate change risks. As a result, many of the portfolio companies do not disclose their exposure to climate change risks. You can imagine investors, of course, care about understanding what's the risk exposure of their portfolio companies to better understand their own risk exposure. Okay? Now, why is this an issue? Well, it's a governance issue because there's the governance issue likely is because of the temporal separation between benefits and downsides of disclosure. Okay? So if you think about it, disclosing your exposure to climate change risk might actually help you manage and mitigate your firm's risk moving forward. Okay? For example, this greater transparency can increase the firm's accountability in the public eyes and strengthen the firm's commitment to manage and mitigate these risks moving forward. This greater transparency can also allow different stakeholders, including investors, customers, and suppliers, to engage with the company, the focal company, in a more informed fashion and potentially help manage these risks. And lastly, we know from large literature that transparency can foster trust. Okay? This can strengthen the firm's relationship with its various constituencies moving forward. Now, the downside of this is that these benefits likely kick in only towards in the longer term, while the potential downsides of disclosure already materialize in the short term. And this includes, for example, that companies, by disclosing their climate change risks, they reveal vulnerabilities that they don't want to really disclose to their investors, for example, that they own stranded assets. In addition, disclosing climate risk information actually entails direct costs because you actually need a human being who assesses these risks, reports it, discloses them. Okay? And lastly, there could be adverse reactions by investors and by other business partners if they realize you as a company are exposed to even greater climate risks than they thought. They might actually pull out and change suppliers, divest from your company or whatever it is. Okay? So this worsens even further the actual exposure to climate change risks. Now, whether the upsides or downsides outweigh which one outweighs which one is not very clear, right? But even if the upsides outweigh the potential downsides, management might actually be reluctant to disclose these exposures to climate change risks. And one reason being is the myopic behavior of managers. Okay? So what we need to know from a large literature in psychology and economics is that individuals more generally, not just managers, but individuals, that they are hyperbolic discounters, meaning we, on average, all have a preference for the short term, an excessive preference for the short term, and so as a result, we prefer short-term rewards over long-term rewards, even if long-term rewards are substantially higher. Now, reasons for this myopic behavior include, for example, cognitive limitations, instant gratification, impatience, etc. Now, if you take this into the context of managers, they are exposed to career concerns, okay, especially in countries where you can get fired pretty much any moment if you don't meet the analyst's expectations. If you're, for example, compensated based on short-term financial performance as opposed to long-term financial performance, etc. Okay, so arguably managers are human beings, I think, last time I checked. But if you then add in addition these different incentive schemes in place and pressures that they are facing, they are likely going to focus even more on the short term than the average human being. As a result, even if basically disclosing the climate risks would be beneficial for the firm in the long term, managers might be reluctant to disclose their exposure to climate change risks because all the focus is on is the short-term downsides of disclosure. Okay? So as a result, in absence of public governance, in absence of mandatory requirements to disclose their exposure to climate change risks, many companies probably fail to disclose their exposure to climate change risks, which would be a fundamentally important information not only for the companies themselves in the world, but also for the investors. And that companies are indeed reluctant to adapt to climate change is also aligned with supported by a recent study. She's actually a junior faculty at the London Business School these days. So she looked at whether companies adapt their business strategies to their exposure to physical climate risks. And to some extent, you can argue it's shocking to understand, to realize that only about 23% of companies adapt in some way to their exposure to climate change risks. And if they do, they only do it in a superficial way, as a quick fix type of thing, as opposed to fundamentally rethinking their business strategies. Okay? So this should send a red alert signal to business and the world and policymakers that we might be fundamentally unprepared for climate change. Okay, so let me put this all together. Okay, so we have an increasing risk and cost of climate change, we have increasing government regulations, we have increasing social pressure from social activists on companies to improve the social environment performance criteria. We have increasing pressure from their own investors to improve their sustainable business practices. And so I think it's fair to say that overall, the advocacy in support of a longer-term orientation as well as more environmental social responsible practices has become much more powerful over the years, which may have led some board of directors to reconsider their corporate governance and redesign the governance structure. For example, by providing long-term compensation, also called ESG-linked compensation, to their managers in order to, again, address these concerns but also improve firm value. Let me briefly touch on these kind of compensation schemes. Okay, so The first one is about time compensation to long-term financial performance. If you think about your own compensation packages, I'm not going to ask you what it looks like, even though that would be really interesting, but rather think about how much of it is really tied to the long term. Or, in much of it, you have fixed pay and you have variable pay. Out of that variable pay, could it be that most of it is tied to short-term performance? Okay? So what we do in this study is look at what happens if actually now a company starts tying compensation slightly more towards long-term financial performance. Does this actually change the behavior of managers? Does it change their investment strategies? Does it change firm value, etc.? So this is essentially time compensation to long-term financial performance potentially helps allow them to overcome the time-based agency conflict that companies face. Okay? I'm going to get to the results afterwards, but another practice that has emerged is time of compensation to specific environmental and social performance criteria. This is often called ESG contracting, so to speak, it should be called ES contracting, or ESG-linked pay, etc. So, for example, companies have started to tie compensation to specific CO2 emission targets, employee satisfaction targets, the compliance with ethical standards, etc. Now, there are several challenges involved with this, okay? But the punchline is, if you think again, if managers are myopic, okay, so you want to have some sort of a tool, a mechanism, to try to help them see the longer term, so that they are more likely going to act in the long-term interest of the company. But in addition, what's special about ESG compensation, you basically try to provide them direction on what stakeholders should they focus on. Because if you think about it, managers, they are faced with multiple pressures from different stakeholders. We would be foolish to think all these stakeholders have exactly the same interests and demands. So basically, the manager, assuming limited financial resources, they just simply can't address all the demands. And even if they did, again, those demands might collide. Okay? So the question then is, what are the stakeholders that managers focus on in absence of any kind of incentives? Well, keeping in mind that they tend to be myopic, and that most likely their careers, etc., depend on financial performance, not necessarily social and environmental performance. Who do they focus on? Well, most likely managers are more likely to focus on those stakeholders who are more salient to the company and financially material in the short term. Okay? That means there is a risk that managers tend to ignore stakeholders that might be very much valuable to the firm in the long term, but don't necessarily have immediate financial implications for the company's operating performance. So I'm talking here about, for example, the natural environment and local communities for mining companies, oil and gas companies, etc. Okay? If you think about it, if the employees, the customers, are upset, well, either they knock on your door or they walk out of your door. The nature is not going to do that. Similarly with local communities somewhere in the Amazon. I mean, now with social media, yes, they might have a voice, but they are less likely gonna make a big fuss out of it and disturb your daily life compared to employees and customers, okay? So in other words, especially in industries for which the natural environment is financially material for the long term, it would potentially be important to tie compensation to these longer term stakeholders that are fundamentally critical to the company's long-term firm value, but who might be ignored by the managers if they're not incentivized to pay attention to those. Okay? So, what we find is indeed, summing these two studies up, the time compensation to these longer-term performance goals or environmental and social performance goals can, on average, not only improve the sustainable business practice of companies and shift the attention of the managers towards the longer term, but also improve firm value and improve long-term operating performance. Not in the short term, but in the longer term. Okay? So, in other words, what are the implications for practice? Well, corporate short-termism is hampering business success. So, in other words, absent proper incentives, managers tend to underinvest in long-term strategies that would be beneficial for the environment and society, as well as their very own companies and investors. Okay? So in other words, the E and S are critically important for the chip. Okay, now let's move over to the financial sector. So what do we know about the relationship of ESG, financial performance, and risk? Based on previous slides, okay, if companies actually engage in environmental and social practices, it can actually be positively correlated with financial performance. Okay? Same time, there is research that looks at the relationship between ESG and risk and finds a negative relationship. I want to comment here, most of these studies are correlational. Okay? But at the margin, well, you know that investors care about risk and returns. So if you look at a whole bunch of big body of literature, you would expect that actually pursuing ESG investment strategies to improve the portfolio performance ESG practices should, on average, at the margin, be beneficial to companies. Right? So, now what are these investing strategies that investors can pursue? Well, on one hand, they can invest in equity, and this is very often what we focus on. Okay? There are different strategies in equities. On one hand, they can do ESG screening, which includes negative screening, so divestment, or thematic screening, where you basically only invest in certain type of companies, for example, only in green companies. Then they can also engage in ESG integration, where investors consider ESG factors. For example, they consider the climate risk exposure of the portfolio companies and decide then whether or not to include them in the portfolio, but also how to weigh them. Okay, so they consider these factors in the portfolio construction. Then there's a more active way of investing, and that includes ESG shareholder engagement. These are behind closed-door conversations of investors, especially the larger institutional investors, with management trying to convey the message they should change their practices. And last but not least, ESG shareholder activism. This is what I talked about before. These shareholder proposals that are submitted to the shareholder meetings, annual meetings, to be voted on by other investors. Now, if you look at what is the most common way sustainable investors actually invest, it's passive. Okay? So this is the most common way. This is also where most of our research focuses on. But if you think about what is actually triggering really change in the real economy, and this is why I discussed the real economy before, what really changes the business practice of a company, this is not passive investing. It's more likely the active engagement. Okay? Because if you think about it, what happens if you divest?
Somebody else will come and invest.
Exactly. What you do, you divest, you clean up your own portfolio, okay? But what really happens in that portfolio company you just divested from? Well, some other investor is going to pick up those shares, potentially for a good price, and potentially nothing changes, right? All you do is clean up your own portfolio. So probably a more effective way would be to stay invested, but then to actively engage with management and force them, not force, actively engage with them and convince them they should improve and change their practices. Obviously, there might be some dynamics where you say, well, if you keep talking to them and they just don't do what I'm saying, maybe then you say, I'm gonna divest. Okay. Now, besides investing in the equity, you can also invest in debt. Okay. So the prime example is our corporate green bonds. These are bonds whose proceeds are committed to investing in green projects. And ever since the emergence of this market, there has been a downright green bond boom. Now, by now, there are different types of ESG fixed income instruments. I'm going to talk about it in a short second. Okay? Let's stick with green bonds for now. So a key question for corporate green bonds is, do they really deliver on their promise to help us transition to a low-carbon economy, or are they just a form of greenwashing? So in other words, are there any real-world implications of issuing green bonds? And so what I find in my study is, on average, companies that issue green bonds indeed showed improvement, subsequent improvement in environmental performance, suggesting that the issuance of green bonds is a signal that a company is indeed intending to go greener. Okay? This is not causal, I just want to be very clear here, but it's a signal that a company wants to shift. Okay? I also find that it helps them attract longer-term and green investors, and that actually green bonds are priced similarly at the primary market as conventional bonds. Now, what is critically important here is actually these results are much stronger for certified bonds. So again, similar as with climate disclosure, there is no public governance really. In most countries around the world, green bonds are essentially the same from a legal perspective as vanilla bonds. Which of course it raises the question, why on earth would a company issue a green bond if what they could do is issue a vanilla bond, and then if it turns out to be the case that the green project is a viable, valuable project, they invest the proceeds of this vanilla bond into the green project. Nothing prevents them from doing so. So why, as a company, would you tie your hands from the beginning saying, I'm going to issue a green bond, and I'm going to invest in green projects, and I'm going to ignore everything else, okay? So again, one potential reason could be greenwashing. Another potential reason is it helps to attract investors you would otherwise not have access to. So for example, if you look at who are the investors that are, not investors, companies that issue the most green bonds, these are actually the companies in emission-intensive industries, such as mining, oil and gas. It might trigger some bad alert here of greenwashing, potentially, but on the other hand, it makes sense, because those folks would not have access to green investors, sustainable investors, unless they issue a green bond. Okay, so it might actually help you attract capital that you would otherwise not have access to. But again, there is a lack of public governance, okay, and so what has kicked in absence of public governance is private, independent third-party certification. And so finding that actually these results only hold for certified green bonds suggests that greenwashing is still a concern for not certified green bonds. It also suggests that certification plays an important role in the governance of this market. Okay? That really certified bonds signals that indeed the company is serious about it, while just issuing green bond, there might not be much around it. Let me perhaps finish and then we take questions afterwards. I think I'm supposed to end in a few minutes. Okay. All right. So, this lack of public governance is likely suboptimal. Okay, there are many open questions. Again, there is a potential, there's a hope that green bonds and similar instruments could potentially be an important tool in helping us finance the transition to a low carbon economy. They are also a potentially important tool to help us finance protection of nature, of biodiversity, etc. But the question is, how can we more effectively do so? How can we improve the governance of this market? So some of the open question marks still. First, what is green is still ambiguous. Second, there are multiple taxonomies which actually might impede effectiveness, efficiency, and integrity of the market. Then, certification at this moment is binary. A binary certification does not contain much information. Okay? So probably much more informative would be a tiered certification scheme like we have for the credit ratings. And there is no criteria of additionality at this moment. So even a certified green bond does not mean it's additional. That means additionality means, would the project have been funded anyway, even without the issuance of green bonds? Now, why is this important? It's not about greenwashing here, correct? The proceeds would be invested into a green project. But the criteria of additionality is important, especially in light of the huge financing gap that we are facing in order to tackle climate change, to finance the protection of biodiversity, mitigation of poverty, social inequality, etc. Okay? So that means those countries that issue green bonds that could otherwise basically fund their projects anyway, essentially are taking those funds away from other projects that are now no longer being funded. Okay? Anyway, lots to improve. It also makes it a very exciting area to go in. Okay? So, in short, a mix of public and private governance is probably more ideal here, and that we need much more research and policy discussion about how to optimally govern this market. Okay, Then, obviously, when we talk about the transition to a low-carbon economy, very often we forget about the social aspect. We forget about, we focus on financing clean tech, we focus on transitioning the hard-to-abate sector. We do not consider the human beings in it. And so what is important is that we have much more discussion, much more research along the lines about how do we transition without worsening social inequalities within countries and across countries. And lastly, the development of these ESG fixed income markets. Sorry about that. So as I mentioned, green bonds was kind of the first child on the block. Ever since then, there has been a proliferation of other ESG fixed income instruments, including transition bonds, climate bonds, SDG bonds, sustainability bonds, you name it. Now, we don't really know much about them. Okay, there is not really any say. It's too early to tell, to have any findings that would be telling of whether there is really any difference between these type of bonds, which ones are effective, etc., etc. Okay, so I think much more discussion, much more research is needed here in order to avoid that this is just another proliferation of greenwashing. Okay, now let me get to actually the core of my presentation. In how many seconds? Excellent. Given that I'm no longer in Switzerland, I can go over time, right? Okay, so if you think about it, we are in the midst of multiple crises: climate change, biodiversity loss, social inequality, poverty, etc. The typical response by academics and practitioners is, it's the government's fault to regulate. Yes. Econ theory tells us government would be the most effective player here to do something. But where is it? Where is the regulation that we need? So, whatever the governments are doing, let me try to be diplomatic, given that this is being recorded. Whatever the governments are doing, it's unfortunately not sufficient to help tackle these grand societal challenges, because otherwise we would not be in the midst of this crisis. And so this puts the spotlight on the private sector, both the real economy and the financial sector. What can they do, and to what extent to help mitigate these grand societal challenges? Now, when you look at the current ESG practices called sustainability, sustainable finance, our thinking, frameworks, theories, practices are really confined to the portfolio level and floor level thinking. What do I mean by that? I'm just going to give you a couple of examples. For example, Scope 1, Scope 2, Scope 3 disclosure. Okay, Scope 1 are the direct emissions of the company, Scope 2 are the emissions of the energy used to consume as a company, and Scope 3 are the emissions of your suppliers and customers. Now, there is debate, for example, at the SEC, there was a debate about mandating the disclosure of Scope 1 and Scope 2, but not Scope 3. If we were to mandate anything, it would be a major improvement in this world, because at this moment, in most countries around the world, as I mentioned before, there is no mandatory disclosure. Okay? So first, that would be an improvement. But if we don't include Scope 3, and there are reasons why not to include Scope 3, but if we don't include Scope 3, what's likely going to happen, and this is what we already observe happening, is companies divest their most emission-intensive operations, or they outsource them. So Scope 1 becomes Scope 3. It becomes an accounting game. On file, the way we currently assess the environmental performance of companies, it looks like they clean up the act. But if you actually think about what really changes in this world, nothing. Because they just reshuffle the emissions to somewhere else. You can make a simple example with diversity, equity, inclusion. Very sensitive, very important topic, especially in the US. The current way we currently practice, most of the companies, DEI, is and the key questions are: how many women and minorities do you have on the board? How many of them do you have in top management? These are very important questions, no doubt, but unlikely sufficient. Because what it might lead to is just a reshuffling of talent from one top company to the other, or from one top university to the other. It does not mean greater accessibility and greater social mobility. It does not mean greater inclusiveness. Okay? This is what I mean by flow-level thinking. The way we currently assess the environment and social performance of companies is we just look at the focal firm, we do not look at the broader system. Let me move over to the financial sector. Again, One example is there's huge pressure on investors to divest from fossil fuel industries and others. If we really care, let's stick with climate. If we really care about addressing climate change, divestment is unlikely the most effective way. Unless you have a very strong assumption that every single investor behaves exactly the same way. Right? So a more likely effective way would be to stay invested and to actively engage with portfolio companies to transition. So to help, for example, the hard-to-abate industries to transition, we need to help them to transition. But they need to transition. Okay. Two more examples before I get to the gist. Okay. So this is what I meant with portfolio level thinking. We just think about the portfolio, we clean up the portfolio, but we don't really think about what's the impact of it. Another example is hedging climate risks. You probably have heard of studies. Don't worry about climate change. You can just hedge away the risk. Can you hedge climate risks? Unlikely. What you can do is you can hedge the portfolio risks against climate news in the short term. But that does not take into account the long-term implications of your investments on climate change, nor does it take into account the increasing risks and costs of climate change on your portfolio's financial performance in the long term. The underlying assumption of the most important theory that we use in finance, both in research and in practice, is that systemic risks are exogenous. So for convenience, in order to get a closed-form solution, we just assume away that there's any relationship between system-level challenges and our business activities. Okay? Last example is, very often, for example, we consider, given a set of rules and regulations imposed by the government, exogenously imposed by the government, what's the ideal actions of investors and companies? We hardly ever ask the question, again, both in research as well as in practice, whether or not and to what extent can companies and investors be actively engaging with policy to help shape the rules of the game. Also, if you look at the metrics that we use, we only look at, for example, Scope 1 emissions of a company. We do not, in our environmental performance assessment of a company, we do not include to what extent does the company lobby against or for climate policy? To what extent do they provide campaign contributions? Right? We just ignore that lower level. And lastly, let me talk about blended finance. Okay? So if we think about how is mitigation of climate change, biodiversity loss, social inequality, poverty, etc., being funded, historically speaking, it's through development funding and philanthropic funding. But there's an enormous financing gap that we are facing. And so the key question is, how can we crowd in more private capital to finance innovative solutions in renewable energy, climate tech, nature-based solutions, social innovation, especially in the global south, where we quite frankly need the money the most? How can we do so? So what has kicked in practice is private capital is blended together with public and philanthropic funding, where basically public and philanthropic capital can help subsidize and de-risk the investment of private capital investors. And so, as such, the blending can serve as a catalyst to help crowd in more private capital and close this financing gap to create social value and mitigate this crisis. We know very little about this practice. The researchers in the room look at how many studies we have on public-private partnerships in terms of finance. So lots to do. So, to sum up, critical factors to mitigate system-level challenges and achieve a more sustainable world. First, we need much better metrics that allow us to track progress towards mitigation of these system-level challenges. We need to move away from just portfolio-level and firm-level focus and adopt a systems-focused approach where we consider this interrelationship between the private real economy and financial sector and the system-level challenges, and to create public-private partnerships in terms of blended finance. Okay? So, my very last slide, I promise. I don't stick to the time, I stick to my slides. Concluding remarks for public pension funds and sovereign wealth funds. So if you think about it, public pension funds and sovereign wealth funds, they are the most exposed to systemic risks. They can't diversify away anymore. They also are amongst the biggest investors and own a large part of the global assets. They have the necessary long-term horizon to actually undertake long-term investments, and they have the capital to do so. In addition, many other investors actually follow their lead. So if you take this all together, you can argue public funds not only have the power and long-term horizon, but also the capability and potentially the responsibility to trigger effective change in this world, in absence of effective public governance. Okay? So, for example, they can trigger effective change by not only improving their own ESG practices of their own companies, but also to engage actively with their portfolio companies to improve their practices, to ask for disclosure of climate change risks, to improve, align executive compensation with these longer-term goals, for example. Then they can invest in certified ESG fixed income instruments, engage in public policy, and engage in these blended finance deals. I'm not saying that these are the only ones, but they certainly have the power, long-term vision, and long-term capital available to do so. So in other words, doing so will likely help not only make the environmental, social, and economic systems more resilient, but also decrease overall systemic risks. And I'm going to stop here. Thank you very much.